Tantor Audio, a division of Recorded Books, presents Platform Capitalism by Nick Srnicek, narrated by Jamie Renell. Introduction. We're told today that we're living in an age of massive transformation. Terms like the sharing economy, the gig economy, and the Fourth Industrial Revolution are tossed around with enticing images of entrepreneurial spirit and flexibility bandied about. As workers, we're to be liberated from the constraints of a permanent career and given the opportunity to make our own way by selling whatever goods and services we might like to offer. As consumers, we're presented with a cornucopia of on-demand services and with the promise of a network of connected devices that cater to our every whim. This is a book on this contemporary moment and its avatars in emerging technologies, platforms, big data, additive manufacturing, advanced robotics, machine learning, and the Internet of Things. It's not the first book to look at these topics, but it takes a different approach from the others. In the existing literature, one group of commentaries focuses on the politics of emerging technology, emphasizing privacy and state surveillance, but leaving aside economic issues around ownership and profitability. Another group looks at how corporations are embodiments of particular ideas and values, and criticizes them for not acting humanely. But again, it neglects the economic context and the imperatives of a capitalist system. Other scholars do examine these emerging economic trends, but present them as sui generis phenomena, disconnected from their history. They never ask why we have this economy today, nor do they recognize how today's economy responds to yesterday's problems. Finally, a number of analyses report on how poor the smart economy is for workers, and how digital labor represents a shift in the relationship between workers and capital. But they leave aside any analysis of broader economic trends and intercapitalist competition. The present book aims to supplement these other perspectives by giving an economic history of capitalism and digital technology, while recognizing the diversity of economic forms and the competitive tensions inherent in the contemporary economy. The simple wager of the book is that we can learn a lot about major tech companies by taking them to be economic actors within a capitalist mode of production. This means abstracting from them as cultural actors defined by the values of the Californian ideology, or as political actors seeking to wield power. By contrast, these actors are compelled to seek out profits in order to fend off competition. This places strict limits on what constitutes possible and predictable expectations of what is likely to occur. Most notably, capitalism demands that firms constantly seek out new avenues for profit, new markets, new commodities, and new means of exploitation. For some, this focus on capital rather than labor may suggest a vulgar economism, but in a world where the labor movement has been significantly weakened, giving capital a priority of agency seems only to reflect reality. Where, then, do we focus our attention if we wish to see the effects of digital technology on capitalism? We might turn to the technology sector, but, strictly speaking, this sector remains a relatively small part of the economy. In the United States, it currently contributes around 6.8% of the value added from private companies and employs about 2.5% of the labor force. By comparison, manufacturing in the deindustrialized United States employs 4 times as many people. In the United Kingdom, manufacturing employs nearly 3 times as many people as the tech sector. This is in part because tech companies are notoriously small. Google has around 60,000 direct employees, Facebook has 12,000, while WhatsApp had 55 employees when it was sold to Facebook for $19 billion, and Instagram had 13 when it was purchased for $1 billion. By comparison, in 1962, the most significant companies employed far larger numbers of workers. AT&T had 564,000 employees, Exxon had 150,000 workers, and GM had 605,000 employees. Thus, when we discuss the digital economy, we should bear in mind that it's something broader than just the tech sector, defined according to standard classifications. As a preliminary definition, we can say that the digital economy refers to those businesses that increasingly rely upon information technology, data, and the Internet for their business models. This is an area that cuts across traditional sectors, including manufacturing, services, transportation, mining, and telecommunications, and is in fact becoming essential to much of the economy today. Understood in this way, the digital economy is far more important than a simple sectoral analysis might suggest. In the first place, it appears to be the most dynamic sector of a contemporary economy, an area from which constant innovation is purportedly emerging, and that seems to be guiding economic growth forward. The digital economy appears to be a leading light in an otherwise rather stagnant economic context. Secondly, digital technology is becoming systematically important, much in the same way as finance. As the digital economy is an increasingly pervasive infrastructure for the contemporary economy, its collapse would be economically devastating. Lastly, because of its dynamism, the digital economy is presented as an ideal that can legitimate contemporary capitalism more broadly. The digital economy is becoming a hegemonic model. Cities are to become smart, businesses must be disruptive, workers are to become flexible, and governments must be lean and intelligent. In this environment, those who work hard can take advantage of the changes and win out, or so we're told. The argument of this book is that with a long decline in manufacturing profitability, capitalism has turned to data as one way to maintain economic growth and vitality in the face of a sluggish production sector. In the 21st century, on the basis of changes in digital technologies, data have become increasingly central to firms and their relations with workers, customers, and other capitalists. The platform has emerged as a new business model, capable of extracting and controlling immense amounts of data, and with this shift, we have seen the rise of large monopolistic firms. Today, the capitalism of the high- and middle-income economies is increasingly dominated by these firms, and the dynamics outlined in this book suggest that the trend is only going to continue. The aim here is to set these platforms in the context of a larger economic history, understand them as a means to generate profit, and outline some of the tendencies they produce as a result. In part, this book is a synthesis of existing work. The discussion in Chapter 1 should be familiar to economic historians, as it outlines the various crises that have laid the groundwork for today's post-2008 economy. It attempts to historicize emerging technologies as an outcome of deeper capitalist tendencies, showing how they are implicated within a system of exploitation, exclusion, and competition. The material in Chapter 2 should be fairly well known to those who follow the business of technology. In many ways, the chapter is an attempt to give clarity to various ongoing discussions in that world, as it lays out a typology and genesis of platforms. By contrast, Chapter 3 hopefully offers something new to everyone. On the basis of the preceding chapters, it attempts to draw out some likely tendencies and to make some broad-brush predictions about the future of platform capitalism. These forward-looking prognoses are essential to any political project. How we conceptualize the past and the future is important for how we think strategically and develop political tactics to transform society today. In short, it makes a difference whether we see emerging technologies as inaugurating a new regime of accumulation or as continuing earlier regimes. This has consequences on the possibility of a crisis and on deciding where that crisis might emerge from. And it has consequences on our envisaging the likely future of labor under capitalism. Part of the argument of this book is that the apparent novelties of the situation obscure the persistence of longer-term trends, but also that today presents important changes that must be grasped by a 21st century left. Understanding our position in a broader context is the first step to creating strategies for transforming it. 1. The long downturn. To understand our contemporary situation, it's necessary to see how it links in with what preceded it. Phenomena that appear to be radical novelties may, in historical light, reveal themselves to be simple continuities. In this chapter, I will argue that there are three moments in the relatively recent history of capitalism that are particularly relevant to the current conjuncture: the response to the 1970s downturn, the boom and bust of the 1990s, and the response to the 2008 crisis. Each of these moments has set the stage for the new digital economy and has determined the ways in which it has developed. All of this must first be set in the context of our broad economic system of capitalism and of the imperatives and constraints it imposes upon enterprises and workers. While capitalism is an incredibly flexible system, it also has certain invariant features which function as broad parameters for any given historical period. If we're to understand the causes, dynamics, and consequences of today's situation, we must first understand how capitalism operates. Capitalism, uniquely among all modes of production to date, is immensely successful at raising productivity levels. This is the key dynamic that expresses capitalist economies' unprecedented capacity to grow at a rapid pace and to raise living standards. What makes capitalism different? This cannot be explained through psychological mechanisms, as though at some time we collectively decided to become greedier or more efficient at producing than our ancestors did. Instead, what explains capitalism's productivity growth is a change in social relationships, particularly property relationships. In pre-capitalist societies, producers had direct access to their means of subsistence, land for farming and housing. Under those conditions, survival didn't systematically depend on how efficiently one's production process was. The vagaries of natural cycles may mean that a crop didn't grow at adequate levels for 1 year, but these were contingent constraints rather than systemic ones. Working sufficiently hard to gain the resources necessary for survival was all that was needed. Under capitalism, this changes. Economic agents are now separated from the means of subsistence, and in order to secure the goods they need for survival, they must now turn to the market. While markets had existed for thousands of years, under capitalism, economic agents were uniquely faced with generalized market dependence. Production, therefore, became oriented towards the market. One had to sell goods in order to make the money needed for purchasing subsistence goods. But as vast numbers of people were now relying upon selling on the market, producers faced competitive pressures. If too costly, their goods wouldn't sell, and they would quickly face the collapse of their business. As a result, generalized market dependency led to a systemic imperative to reduce production costs in relation to prices. This can be done in a variety of ways, but the most significant methods were the adoption of efficient technologies and techniques in the labor process, specialization, and the sabotage of competitors. The outcome of these competitive actions was eventually expressed in the medium-term tendencies of capitalism. Prices tangentially declined to the level of costs, profits across different industries tended to become equal, and relentless growth imposed itself as the ultimate logic of capitalism. This logic of accumulation became an implicit and taken-for-granted element embedded within every business decision: whom to hire, where to invest, what to build, what to produce, who to sell to, and so on. One of the most important consequences of this schematic model of capitalism is that it demands constant technological change. In the effort to cut costs, beat out competitors, control workers, reduce turnover time, and gain market share, capitalists are incentivized to continually transform the labor process. This was the source of capitalism's immense dynamism, as capitalists tend to increase labor productivity constantly and to outdo one another in generating profits efficiently. But technology is also central to capitalism for other reasons, which we will examine in more detail later on. It's often been used to de-skill workers and undermine the power of skilled laborers, though there are counter-tendencies toward re-skilling as well. These de-skilling technologies enable cheaper and more pliable workers to come in and replace the skilled ones, as well as transferring the mental processes of work to management, rather than leaving it in the hands of workers on the shop floor. Behind these technical changes, however, lies competition and struggle, both between classes in their struggle to gain strength at one another's expense, and between capitalists in their efforts to lower the costs of production below the social average. It's the latter dynamic in particular that will play a key role in the changes that lie at heart of this book. But before we can understand the digital economy, we must look back to an earlier period. The end of the post-war exception. It's increasingly obvious to many that we live in a time still coming to terms with the breakdown of the post-war settlement. Thomas Piketty argues that the reduction in inequality after the Second World War was an exception to the general rule of capitalism. Robert Gordon sees high productivity growth in the middle of the 20th century as an exception to the historical norm, and numerous thinkers on the left have long argued that the post-war period was an unsustainably good period for capitalism. That exceptional moment, broadly defined at the international level by embedded liberalism, at the national level by social democratic consensus, and at the economic level by Fordism, has been falling apart since the 1970s. What characterized the post-war situation of the high-income economies? For our purposes, two elements are crucial, though not exhaustive: the business model and the nature of employment. After the devastation of the Second World War, American manufacturing was in a globally dominant position. It was marked by large manufacturing plants built along Fordist lines, with the automobile industry functioning as the paradigm. These factories were oriented towards mass production, top-down managerial control, and a just-in-case approach that demanded extra workers and extra inventories in case of surges in demand. The labor process was organized along Taylorist principles, which sought to break tasks down into smaller, de-skilled pieces and to reorganize them in the most efficient way. And workers were gathered together in large numbers in single factories. This gave rise to the mass worker, capable of developing a collective identity on the basis of fellow workers sharing in the same conditions. Workers in this period were represented by trade unions that reached a balance with capital and repressed more radical initiatives. Collective bargaining ensured that wages grew at a healthy pace, and workers were increasingly bundled into manufacturing industries with relatively permanent jobs, high wages, and guaranteed pensions. Meanwhile, the welfare state redistributed money to those left outside the labor market. As its nearest competitors were devastated by the war, American manufacturing profited and was the powerhouse of the post-war era. Yet Japan and Germany had their own comparative advantages, notably relatively low labor costs, skilled labor forces, advantageous exchange rates, and, in Japan's case, a highly supportive institutional structure between government, banks, and key firms. Furthermore, the American Marshall Plan laid the groundwork for expanding export markets and for rising investment levels across these countries. Between the 1950s and the 1960s, Japanese and German manufacturing grew rapidly in terms of output and productivity. Most importantly, as the world market developed and global demand grew, Japanese and German firms began to cut into the share of American firms. Suddenly, there were multiple major manufacturers that produced for the world market. The consequence was that global manufacturing reached a point of overcapacity and overproduction that put downward pressure on the prices of manufactured goods. By the mid-1960s, American manufacturing was being undercut in terms of prices by its Japanese and German competitors, which led to a crisis of profitability for domestic firms. The high fixed costs of the United States were simply no longer able to beat the prices of its competitors. Through a series of exchange rate adaptations, this crisis of profitability was eventually transmitted to Japan and Germany, and the global crisis of the 1970s was underway. In the face of declining profitability, manufacturers made efforts to revive their businesses. In the first place, firms turned to their successful competitors and began to model themselves after them. The American Fordist model was to be replaced by the Japanese Toyotist model. In terms of the labor process, production was to be streamlined. a sort of hyper-Taylorism aimed to break the process down into its smallest components and to ensure that as few impediments and downtime entered into the sequence. The entire process was reorganized to be as lean as possible. Companies were increasingly told by shareholders and management consultants to cut back to their core competencies, any excess workers being laid off and inventories kept to a minimum. This was mandated and enabled by the rise of increasingly sophisticated supply chain software, as manufacturers would demand and expect supplies to arrive as needed, and there was a move away from the mass production of homogeneous goods and towards increasingly customized goods that responded to consumer demand. Yet these efforts met with counter-attempts by Japanese and German competitors to increase their own profitability, along with the introduction of new competitors, Korea, Taiwan, Singapore, and eventually China. The result was continued international competition, overcapacity, and downward pressures on prices. The second major attempt to revive profitability was through an attack on the power of labor. Unions across the Western world faced an all-out assault and were eventually broken. Trade unions faced new legal hurdles, the deregulation of various industries, and a subsequent decline in membership. Businesses took advantage of this to reduce wages and increasingly to outsource jobs. Early outsourcing involved jobs with goods that could be shipped, for example, small consumer goods, while non-tradable services, for example, administration, and non-tradable goods, for example, houses, remained. Yet in the 1990s, information and communications technologies enabled a number of those services to be offshored, and the relevant distinction came to be the one between services that required face-to-face encounters, for example, haircuts, care work, and impersonal services that did not, for example, data entry, customer service, radiologists, etc. The former were contracted out domestically where possible, while the latter were under increasing pressure from global labor markets. Hospitality provides one illuminating example of this general trend. The percentage of franchised hotels in the United States raised from a marginal figure in the 1960s to over 76% by 2006. Alongside this, there was a move towards contracting all other work associated with hospitality, cleaning, management, maintenance, and janitorial services. The drivers behind this shift were to reduce benefits and liability costs in an effort to maintain profitability levels. These changes inaugurated the secular trends we have seen since, with employment being increasingly flexible, low wage, and subject to pressures from management. The dot-com boom and bust. The 1970s therefore set the stage for the lengthy slump in manufacturing profitability that has since been the baseline of advanced economies. A period of healthy manufacturing growth in the United States began when the dollar was devalued in the Plaza Accord, 1985. But manufacturing slumped again when the yen and the mark were devalued over fears of Japanese collapse. And while economic growth recovered from its 1970s lows, nevertheless the G7 countries have all seen both economic and productivity growth trend downward. The one notable exception was the dot-com boom in the 1990s and its associated frenzy of interest in the possibilities of the Internet. In fact, the 1990s boom is redolent of much of today's fascination with the sharing economy, the Internet of Things, and other tech-enabled businesses. It will remain to the next chapter to show us whether the fate of these recent developments will follow the same downward path as well. For our present purposes, the most significant aspects of the 1990s boom and bust were the installation of an infrastructural basis for the digital economy and the turn to an ultra-accommodative monetary policy in response to economic problems. The boom in the 1990s amounted effectively to the fateful commercialization of what had been, until that point, a largely non-commercial Internet. It was an era driven by financial speculation, which was in turn fostered by large amounts of venture capital, VC, and expressed in high levels of stock valuation. As U.S. manufacturing began to stall after the reversal of the Plaza Accord, the telecommunications sector became the favored outlet of financial capital in the late 1990s. It was a vast new sector, and the imperative for profit latched onto the possibilities afforded by getting people and businesses online. When this sector was at its height, nearly 1% of U.S. gross domestic product, GDP, consisted of VC invested in tech companies, and the average size of VC deals quadrupled between 1996 and 2000. All told, more than 50,000 companies were formed to commercialize the Internet, and more than $256 billion was provided to them. Investors chased hopes for future profitability, and companies adopted a growth-before-profits model. While many of these businesses lacked a revenue source, and even more lacked any profits, the hope was that through rapid growth they would be able to grab market share and eventually dominate what was assumed to be a major new industry. In what would come to characterize the Internet-based sector to this day, it appeared a requirement that companies aim for monopolistic dominance. In the cutthroat early stages, investors enthusiastically joined, in hopes of picking the eventual winner. Many companies didn't have to rely on VC either, as the equity markets swooned over tech stocks. Initially driven by declining borrowing costs and rising corporate profits, the stock market boom came unmoored from the real economy when it latched onto the new economy promised by Internet-based companies. During its peak period between 1997 and 2000, technology stocks rose 300% and took on a market capitalization of $5 trillion. This excitement about the new industry translated into a massive injection of capital into the fixed assets of the Internet. While investment in computers and information technology had been going on for decades, the level of investment in the period between 1995 and 2000 remains unprecedented to this day. In 1980, the level of annual investment in computers and peripheral equipment was $50.1 billion. By 1990, it had reached $154.6 billion, and at the height of the bubble in 2000, it reached an unsurpassed peak of $412.8 billion. This was a global shift as well. In the low-income economies, telecommunications was the largest sector for foreign direct investment in the 1990s, with over $331 billion invested in it. Companies began spending extraordinary amounts to modernize their computing infrastructure, and in conjunction with a series of regulatory changes introduced by the U.S. government, this laid the basis for the mainstreaming of the Internet in the early years of the new millennium. Concretely, this investment meant that millions of miles of fiber optic and submarine cables were laid out, major advances in software and network design were established, and large investments in databases and servers were made. This process also accelerated the outsourcing tendency initiated in the 1970s, when coordination costs were drastically cut as global communication and supply chains became easier to build and manage. Companies pushed more and more of their components outwards, and Nike became an emblem of the lean firm. Branding and design were managed in the high-income economies, while manufacturing and assembly were outsourced to sweatshops in the low-income economies. In all of these ways, the 1990s tech boom was a bubble that laid the groundwork for the digital economy to come. In 1998, as the East Asian crisis gathered pace, the U.S. boom began to stumble as well. The bust was staved off through a series of rapid interest rate reductions made by the U.S. Federal Reserve, and these reductions marked the beginning of a lengthy period of ultra-easy monetary policy. Implicitly, the goal was to let equity markets continue to rise despite their irrational exuberance, in an effort to increase the nominal wealth of companies and households, and hence their propensity to invest and consume. In a world where the U.S. government was trying to reduce its deficits, fiscal stimulus was out of the question. This asset-priced Keynesianism offered an alternative way to get the economy growing in the absence of deficit spending and competitive manufacturing. It was a signal shift in the U.S. economy, Without a revival of U.S. manufacturing, profitability was necessarily sought in other sectors. And it worked for a time, as it facilitated further investment in new dot-com companies and kept the asset bubble running until 2000, when the National Association of Securities Dealers...
Sample complete. Ready to continue?